Hello and welcome to 34 diagrams drawn in 34 days. Today is day 9 and we are going to draw a tariff diagram. We're going to draw our diagram and I'm going to draw it a bit squeezed together so that we have more space to look at the tiny detail. So I'm going to draw price and quantity. Demand goes downwards, that's demand, and supply to the sky. We know that in a free market, in a closed economy, the market would clear, and we're going to call that QD1. So that's the domestic demand in a free, closed economy, D1. Then, if we opened up our market and allowed other countries to trade with us, they might be able to specialize. It is likely that their prices would be a lot lower than ours, and so the world price would undercut us at world price. Now that is excellent news for consumers because previously their consumer surplus was this triangle. Now their consumer surplus is this massive triangle. This is going to be QW. That's the quantity that the world will supply and that we will demand. It's not a great thing for our domestic firms. So our firms are going to see a huge contraction and we're going to call that QD2. Now the reason I call it D2 is because that is the quantity that would be bought domestically, and then this gap would be filled by imports. So the gap between D2 and W2 will be imports. This is the setup of our tariff diagram. If we introduce the tariff, that would be a tax on all imports. It would increase the world price artificially. So that is world price plus tax, or plus the tariff. Compared to having an open economy with imports, that's good for our suppliers. There'll be an extension supply. And so now the quantity being demanded domestically is going to be QD3. Because the price has increased for consumers, because they're now having to pay for this tariff, it's going to be a contraction along demand. And this is now going to be QD1, just so I can come up with a label.